A recent article published on Seeking Alpha argues that Palantir is worth only $5 per share, sparking outrage among investors. But let's break down the claims and examine if there's validity or if this is just more FUD, fear, uncertainty, and doubt about the company's future. To be fair, this isn't a personal attack on the author. We're here to analyze the claims constructively. The article brings up two main points. First, that Palantir's business model isn't scalable or profitable, and second, that excessive stock dilution leaves little value for shareholders. Let's start with scalability and profitability. The article suggests that Palantir's business can't scale, implying it's not profitable. However, this argument seems misleading. Over the last year, Palantir recorded an operational profit of $220 million and generated over $500 million in free cash flow. But why isn't Palantir reporting traditional profits? Simply put, they're reinvesting these funds into research and development, loan repayments, and building a more resilient business to stay ahead of competitors. Palantir recently repaid a $550 million loan as a hedge against inflation and financial uncertainties. This proactive move reflects their commitment to long-term stability, not a lack of profitability. While other companies might distribute cash as dividends to inflate stock prices, Palantir is using it to strengthen its core. This approach may disappoint short-term investors but aligns with Palantir's long-term goals, especially as new competitors enter the data analytics market. Now, on to the topic of institutional ownership. Contrary to the article's implication that retail investors are stuck holding the bag, institutional ownership has been growing. Big players like BlackRock, Vanguard, and ARK Invest have increased their shares, doubling institutional holdings to 700 million shares in just 4 months. This growth in institutional interest suggests confidence in Palantir's potential, countering the idea that only uninformed investors are interested in this stock. The second big claim is that stock dilution is out of control, making it less attractive to investors. The article accuses Palantir of diluting shares through stock-based compensation for executives and insiders. However, it's crucial to distinguish between actual share issuance and the share float. The number of shares Palantir issued at its public offering has not increased. Yes, the float has grown as more shares are released to the market, but this doesn't mean the company is creating new shares out of thin air. Every share issued through stock-based compensation was already part of the total count at the time of their IPO. Finally, there's the issue of insider selling. The article portrays this as a sell-off by company executives, but most of these sales are part of pre-scheduled 10b5-1 plans. When executives like CEO Alex Karp sell shares, it's often to cover tax liabilities on stock options, not a lack of confidence in the company. Elon Musk used this same approach with Tesla, and it's common for executives with substantial options packages. Moreover, Karp's major share exercises are now complete, meaning large-scale insider sales won't likely resume until his next tranche matures years down the line. So, is Palantir truly a $5 stock? Unlikely. Given its growing institutional ownership, strategic reinvestments, and expanding market lead, Palantir is likely undervalued at the price point suggested by the article. If you're here for the short term, you may feel the pressure of recent stock fluctuations. But if you're in it for the long game, these ups and downs are part of the journey. Thank you for tuning in. If you appreciate this content and want to support more deep dives, consider joining our Patreon. Link is in the pinned comment. Don't forget to like, comment, and subscribe for more updates.